Good morning, everybody, and thank you for joining us for this edition of Everything Real Estate with Dee Richards from Coldwell Banker. She is going to be discussing today the battle of investments, real estate versus the stock market, with her guest, Dan Newquist from Buckingham Financial Wealth Management. So without any ado whatsoever, I'll kick it over to you, Dee.
Thank you, Miss Lori and the Chamber of Commerce for hosting these every other Tuesday. It's always so much fun. And I can do this battle. We're doing the battle of investments today. And I can do that with my good friend, Dan, who I've known for, I don't know, Danny, it's been a really long time, like 30 years.
Don't even say it. You know, we're already old.
Speak for yourself. So I'm not old. So we can do this together. We'll have a lot of fun. And, you know, real estate, there's a place in everybody's financial plan, I think, for real estate and investments. So we're going to talk a lot about how these different investments perform over the long term. I think some of you will be surprised at what you see. And it's really not a battle of who wins. It's really just looking at each individual one. Of course, you know, if you're investing, you're winning, hopefully, if you have the right people in your corner. And we'll just learn some things and have some fun. So this is me. I'm Dee Richards. I am, just like Danny, native to Morgan Hill. My family's been here for 5 decades. So my husband calls us early settlers. And I'm a mom, a wife, an organic gardener, and an enthusiastic wine consumer, especially through pandemic. But shedding those pandemic pounds has been tough, I have to tell you. There's my contact information there. And then Dan, do you want to introduce yourself?
Well, yeah, my name is Dan Newquist. I've been a financial advisor for 24 and a half years. And as Dee said, I'm early settler too, because, you know, born and raised here. Parents moved here in, I don't know, 1970, 71, so I don't know what. But I've been in the business for a while, you know, and I think this will be fun. Because you have to realize that the real estate and stock market, they're different asset classes, but how they perform together or not, or how they fit into a portfolio, that's what's key. And I think that's what the main thing that I believe Dee and I want to get for you is information, just about what you're comfortable with and how to go forward. But that's what I've done all my career. So let's have some fun, Dee.
Let's have some fun. All right.
Perfect. And is this a competition?
Well, you know, I'm pretty competitive, but with you, no, it's not. It's really, I don't know, someone might win, but we'll see. We'll have to see.
It all depends on everybody's situation on who wins.
Exactly. It depends. You know, like I said, if you have the right people in your corner and you're investing in any investment asset class, then you're going to win more than likely, especially over the long term.
Exactly.
So what we'll cover today, we're going to do, Dan's going to do an overview of the current financial market. I'll have some questions. And then we're going to look at how the stock market performs over the long term on average. And what might be coming, what you think is coming, Dan, if you can look into your crystal ball. What's going to be coming in Q4, since it's right around the corner. And then into 2022, I cannot believe we're already talking about 2022. And then I'll be talking about kind of an overview of the current real estate market locally, how the real estate market has performed over time. I think you might be surprised at a few different things that we'll show. And then what I think might be coming in the real estate market for Q4 and into 2022. And then we'll take some questions. So Dan, we're going to kick it off with you. I want to do a little financial update. And I have questions about inflation. Is it transitory? Is it structural? We keep hearing Jerome Powell talk about it being transitory, but I'm not so sure, because, you know, this is crazy. I got an oil change the other day, went down to Jiffy Lube, got my oil changed a year and a half ago. I would say it was maybe $65, $70. It was $100 just for the oil change, nothing fancy. And I was surprised at that, but employers are now having to pay their workers more money. So to say that it's transitory, I don't know. Employers have to recoup the extra money that they're paying out to employees in large part. So what do you think?
Yeah, well, I mean, you have to think about this, though. They could pay their employees more when they're charging more. So your $65 went up to $100. That's $35 extra. So it's all about the situation. I mean, honestly, with this financial market right now, I mean, I think we're going through some correction right now. I know we're having really volatile right now, but people have to remember how long this bull market has been going and how it's been going. With this COVID, we've had a lot of stimulus put in there. It's now at the head of with the Republicans and Democrats being teenagers and fighting each other all the time, and little kids and being little, excuse me, but jerks, and not thinking about us, thinking about what's going on for the government. And people might argue with me or whatever, that's perfectly fine. But my opinion is that we should be first. We are the employees that are making the money to do the GDP, that the GDP has been okay, gross domestic product. But to take care of this debt and everything that the government has done, it's kind of crazy. We will have to raise taxes here soon. And that's what's coming into play right now, plus inflation. Even though the core inflation they say is under control, I mean, like what you said, hey, look at oil and look at groceries. I mean, that's the things that they take out of the core inflation that the government shows, because I mean, it's very volatile. But still, with the market right now where we are, I am having my clients stay the course, but their allocations and everything, if it needs to be changed because of the risk tolerance or anything, then that's when we look at what's going on. But I don't give a full overview of the financial markets, but right now, I mean, I'm staying the course, but making adjustments where needed per each situation, each person. Right now, my own father, and I could talk about him because he said that I could, but Gary Newquist, I'm not telling about numbers or anything, but his allocations, he's 83. And honestly, he's still a 50-50 portfolio, 50% in fixed income, 50% in the overall international, everything worldwide stock market.
Wow.
But it's all diversified. And that's the main thing about the financial market. Yes, it's going to go up and down, but you have to realize where we are now, where we will be, and also time in the market, not timing of the market is what counts.
So that's important to note, Dan. And I think we all try and time the market. We see, this is what I woke up to this morning, reds in my personal portfolio. So Danny has one of my portfolios. I have a few, I kind of sprinkle them around. And so this is my personal one, and it's all red except for my Alibaba stock, which went down and then came back up. So we have seen so much change since COVID hit. We've seen so much change in the housing market, in how we work, in how we shop, in how we vacation, and so much more. Is the way that we are investing changing?
What do you mean by that? As in, like, what you're investing in? Yes, but I mean, what do you mean by that? Because that's a real broad question. How we're investing, yes, we have to invest to make money, but the main thing is every situation is different. And when you're looking at those reds that you just put up there, and people are looking at the S&P 500, that's 500 stocks, and that's 500 stocks, and that's not your portfolio. We have to remember that everybody's portfolio is in allocations of, that's not as in your portfolio, Deneen, I didn't mean that, but as in your specific portfolio, anybody who's listening, you have to look at what you're in. If you have 50% fixed income, you're going to have usually 50% less volatility than the market. So how we're investing, you have to be smart about it. You have to remember, what's this money geared for? If we're younger, it's for retirement, or how you're going to touch it in a year. So it's the planning process. That's the biggest thing.
I agree. Planning
process. And income and liquidity. Yep.
So there's a couple of different takes on, are we investing differently? We've seen over the last year, Bitcoin go bananas, right? Up and down like crazy. We follow on social media, we follow people like Elon Musk and Jeff Bezos, and we buy based on, well, not we, but some people buy, we as the aggregate of people. We buy based on what we're reading in social media. We saw this year or last year, we saw kids on Robinhood drive up gaming stocks in insane amounts, and then they came back down. So is the way that we, the American public, are investing? Has that changed because of the pandemic?
Let me ask you that. No, the pandemic really didn't have much to do with the investing. Initially, yes, but let me ask you this. In year 2000, weren't we doing the same thing as people are doing now? Building up prices, GameStop? Well, I mean, and so.
But other people aren't necessarily.
Yeah, there's still a lot of people, and since you just mentioned Robinhood on different things about, building up a stock, it's all there. And, that's why diversification and the allocation is what's very key to each individual's portfolio. The investing, if you could bring up any, Bitcoin, shoot, I don't care what it is, pork bellies, whatever it is, people invest in it. Okay. Our investment system is it's an auction market. If people want it, they're going to pay more for it. If people don't, they're not going to buy it, or they're going to buy at a certain price that's lower. So it has to have both sides of the table of buying and selling, or the stock's not going to move. The company's going to go under, basically, or not have the liquidity in the open market, being, a public offering and everything. So it really depends on the situation, how we're investing. We can look back at history, and I'm not sure if you can pick up my slide. I'm not able to share my screen.
You want to go to the winner, the next winner?
I want to go to the next winner. Yeah. So can you pick the next winner? So if we look at this, this is DFA as Dimensional Fund Advisors. They're like American Funds or Fidelity of the 401k or retirement plan business. You need a lot of money just to invest in, but we're an institution. We can invest in these and get information from them. But the main thing is what we're looking at is this is all different asset classes. Now, again, bringing up different stock picking, that's a different story. I do not do that. I think that's too risky for people. But it depends on what you're doing with it. Now, Dee, with your core portfolio, you do what you need to do with it, but you have your play time. Right. Which you should have, if people want to do that, they can do that. Yep.
And that's all in the red today.
Exactly. And it's perfect. And it's perfectly fine. I want people to, be involved with it. But if we look at the different colors, this is our Skittles chart. We can look at the S&P, which is the light blue, and looking at the light blue, it's all over the place, correct?
Yeah.
If we look at this is only till 2019. Sorry. I saw that after I gave it to you. But 1995 to 2019, you could see the annual returns from that. And there's all different kinds of things. You could see the Dow Jones US REIT index. If we're talking about real estate in the stock market, there's the darker blue. And you could see that's all over the place too, And so if we look at what's going on, we have to make sure that we're diversified in a risk or a type of portfolio that adjusts to your risk or what you can have in the red and what your goals are. It's not always about performance. Yes, we want to make money, but it's about the downside risk. Once you start taking distributions and are in retirement and need that money, we want to do a financial plan that'll do the probability that'll make sure that your income from that portfolio will last you forever.
Right.
That's the key to all of this, how we're investing, and we're investing differently. Yes, it's always changing, but the whole main thing is making sure that my clients are taken care of and in a portfolio that's going to adjust for their lifestyle, make money for them, but not to any extent that's going to add risk and have the downside risk, which we're going to see here soon, really bad. We want to, 2008, 2009, my portfolios were down maybe only 20, 25%, still bad, but the stock market itself was down almost 60 when it was 2008, beginning of 2009.
Yeah, scary times. You just mentioned we're going to be seeing a change here.
Well, we're going to be change, as in, you mean with the stock market, as in we're going to see corrections here. Yes, okay. We will see corrections. We see them all the years. How long it'll last, I don't know. This is way up in the air.
Okay, right, that's one of your predictions. We're going to see some corrections, but we did today.
Yeah, right? Yeah, we're seeing them.
You want to go to the next slide?
Yeah, go for it.
Okay, diversification.
Yeah, so when we look at this overall, did I give you this one right? Okay. So when we look at this is a diversified portfolio, and the P1, P2, P3, basically this is the allocations. Okay. This is what I wanted to show you on performance. Now, this is from January 82 to 2019 December. Okay. If we look at the P1, which if you look at that, 40% in the Treasury notes, 24% in international, that's Europe, Asia, and Far East, that's the EFA, and then 36 in S&P 500. That is very, very aggressive, correct? Well, we would think so. Analyzed return is about 8.6%. Standardized standard deviation, which is the volatility, is 10.5. Okay, which you're like, okay, whatever that means, right? If we go to the next ones, I'm going to go down to P3 because I know about time. P3 is a fully diversified portfolio with small cap, large cap, international, everything in there, you know? And I want to show you that the annualized rate of return compared is up compared to the more aggressive portfolio, correct?
So the
Or more,
P1 is
in
portfolio
more
one,
or
portfolio
less,
two,
I should say,
portfolio two.
excuse me, not more aggressive portfolio, but less diversified portfolio.
Okay.
Okay. When you get to the more diversification, look at over that time frame, the dollar grew to 33.66 compared to 23.24. Okay. Standard deviation, the risk is up a little bit from it, but the return is what's key. Okay. That's what you want to make sure when you're looking at things is what, you know, what that return and the risk is going to do with your portfolio, your income down the line.
What's a Sharpe ratio?
Well, that's, I should have cut that one out. Sharpe ratio is how much it's going to go up and down with the S&P 500 or the market itself.
Okay.
Okay, so it's only 60%. It's only 60% 0.59, okay, or 60% of the risk of the S&P 500. Okay.
So is there a number that you recommend that people have? Is there like a sweet spot of the number of stocks?
That's a big question. Like I said, my dad's 50-50, 50% fixed income, 50% equities. He's 83. I have my client sitting next to me. He's about the same age. I don't have him in that. Okay. So it all depends on the situation.
Okay.
50-50 going through bad times and everything. Usually I look at a 50-50 portfolio because when the stock market does tank, we have half of the portfolio out of the market that we can buy low because we invest in good funds. They've done great. Okay. We don't want to just sell out everything when the bad times happen. That's when you want to buy.
Absolutely. Like maybe today.
I would wait a little bit.
Whoa. Okay. Danny says, wait. All right.
It's just so volatile. It's so volatile.
Thank you. Anything else before we move on to real estate?
No, just remember, you know, diversification really counts, and your income and being more key to what your expenses are going to be in retirement. That's what's very key. Performance is not the number one thing when you're in retirement.
And you can help you do that. So you sat down with my husband and I, and you have some amazing tools that I've never seen before. And I look at a lot out there. And we've been investing for many, many years in the stock market. I'm more of a real estate person, obviously. And Mark is more of in the financial markets. It's just the way his brain works.
Perfect match.
Towards. And we're a good mix together.
It's a good match.
Yeah. So you sat down with us and we looked at what we felt our expenses were going to be in retirement. You have worksheets for this that you can give people that they can fill out what they think their expenses are going to be in retirement. And then we back into that number. What can we put our funds and our money into that will get us that income that we need in retirement without running out of money, as you mentioned. And people are living a lot longer these days. So you really have to plan for that. Yeah.
Well, the other key thing, and we'll get to your real estate because I know of time, but is the health factor.
Yes.
When to take Social Security, Medicare, what options, you know, the insurance and medical costs and everything are just going sky high.
Right.
You know, so that's one key thing that we have to look at with, you know, your expenses.
Right. Yeah. You almost can't have too much money, right? You need to have it.
Because if you could get by with a portfolio that has low risk and the return that you need to take care of you for the rest of your life, I would rather have that.
Sure.
Than trying to hit the next home run or something, you know?
Right. No, there's more security in that, but most people don't have that.
Nope. Exactly.
Yes.
Exactly.
Okay, let's talk about real estate. So if you're thinking of selling right now, we still have a very low volume of homes on the market. We had a little bit of a pullback in the summertime. Everybody went on vacation because we could. So for the first time in over a year, people were able to actually travel again, and they did. So we definitely saw less demand. And I took advantage of that for my buyer clients and got some people into escrow, and they weren't competing against 15 or 20 other offers. They were competing against 2 or 3, and that really helped. But we still have, on average, I look at the MLS almost every day and how many homes are on the market. And I'm looking at single family homes. When I talk about here today is about single family homes. There's not enough time to parse out every fragment of the real estate market. But with single family homes, we're averaging, 50 to 55 a day in Morgan Hill, which is nothing for a town of almost 50,000 people. I think we are just about now, just nothing. And we're not building a whole lot. So that will come. We have a lot of things slated to be built in town, but there's nothing really happening right now, especially that's fairly affordable. So it's still very much a seller's market. Things are still selling very quickly as well. Homes that are well priced are selling really fast. So if they look great and they're priced well, they sell very quickly. I had 2 listings that came on almost, one week and one the week after. One sold in 5 days, the next sold in 4. And we had 35 people through an open house for a single family home in Gilroy. Bananas. So that was just insane. And we had 4 offers on that one and a little bit of a bidding war. So those are still happening, but the houses have to look really good. So not always, that's a little bit of a generalization, but the better your house looks, the more money you're going to get for it really in any market, and the more quickly it will sell. We are seeing price reductions, so you do have to be careful that you're not overpricing your home. There is, I think, a misnomer that, I don't have to fix anything. I can just throw it onto the market and it'll sell. And it will, but it won't sell for the highest price. So definitely taking the time to make your house look great, fix anything that needs to be fixed. In my last sale in Gilroy, we took about 4 or 5 weeks just to get the house prepped, ready to go, painting and just fixing little things here and there, and definitely paid off. It sold for $100,000 over asking. So, and that was the one we had 35 people through the open house. So it definitely paid off to do that. And then if you're thinking about buying, get ready, because it is still a seller's market. We are still seeing multiple offers on many properties, not every single one, but many of them. And you want to look as good financially as you possibly can. That means not only getting pre-approved, but going through the underwriting process, direct underwriting, or they sometimes call it desktop underwriting, where you basically have a loan and you just need to identify a property for that loan versus identifying a property and then getting a loan, which is kind of the reverse. So it just makes you look better, and it's a little bit easier to get your your offer accepted that way, and be ready to move quickly. Gosh, I was out in Monterey with a client yesterday, and it's her first home that she's looking to purchase, which is super exciting. And a house came on the market around noon. We booked an appointment to see it within an hour. We were there at 4:30. By 7, it had an offer already. So it's just crazy, but it's beautiful. I mean, it's completely turnkey and ready to go. So the beautiful ones are selling very, very quickly. And then the other thing is you might need to waive all of your contingencies to get an offer accepted, because so many buyers are. And to be competitive, you might not be able to have a loan contingency, which is why you want to go through the underwriting process ahead of time. You might not be able to have an inspection contingency. Normally, we get all of our reports up front, so the buyer has them to look at before they write an offer. And the appraisal contingency we're often seeing waived as well. Sometimes if you need to sell a home and buy, it's a little bit easier right now. I did get somebody in a contract a couple of weeks ago where they needed to sell and buy at the same time. They hadn't sold their house yet, although it was sold in a few days. Those have been very hard to do over the last year, but we're seeing a few of them from time to time. But there's a lot of planning involved. Just like planning for retirement, you've got to plan to get into this housing market and win. So the sooner you can talk to your realtor and your lender about what you need to do and how to do it and what you're looking for, the better.
Hey, Dee Dee, can you do the differences between pre-qualified and pre-approved and why it's important for one over the other?
Yes. So pre-qualified is really nothing these days. Nobody gets pre-qualified anymore. It's really you're pre-approved. So pre-qualified, someone just asks you some questions and says, yeah, we think you can get a loan. Pre-qualification means they've looked at your tax returns, look at your income, they look at your debts, and they give you an amount, a figure that you can buy. Take it one step further, and that's going through the underwriting process before you're in contract, where you go to the underwriter and you go through, they pick through all of your tax returns line by line. They look at all of your debts more carefully. They ask more questions. They ask for more documentation, and that can take a couple of weeks to do, depending on what your file looks like. So those are really the 3 stages. Nobody even talks about pre-qualifying anymore. It just doesn't mean really anything. So I would never look at an offer that has someone that's pre-qualified. I want someone that is actually approved to get a loan, but preferably I want them to go through underwriting. So I know there aren't going to be missteps at the last minute and they won't be able to get a loan. We looked at another condo yesterday and it had fallen out of escrow because the buyer couldn't qualify for a loan. That would never happen on one of my listings because I make sure that they can qualify for a buyer can qualify for a loan before they make an offer or while they're making the offer. I talk to their lender, I ask questions, and it just doesn't happen. That answer the question?
Yes, ma'am.
Awesome.
Thank you.
You got it. So this slide is really interesting because I have a lot of buyers that will call me up and say, when do you think prices are going down? When we have a recession, prices are going to bottom out. They've topped out so much. People are crazy with these prices and we're going to buy when there's the next recession. And this is a slide from Mike Gallagher, who's a local lender in town. So hi, Mike, if you're watching. And he's with Finance of America. He's fantastic. And he talks about this all the time, and I love it because it shows the red line shows you the average of home appreciation and also shows you the dips, which are the gray line, or the gray lines are the recessions, and it shows you the dips with the blue lines. So you can see that on most of the recessions, we saw prices stay stable or even go up a little bit. The last big recession of 2008, which lasted several years and caused so many problems, that's what people remember. And that's what's fresh in our minds, but that's not what historically has happened. So a recession, an economic recession, does not necessarily mean that home prices are going to tank. It's just what we associated with the last recession, which was a Great Recession, and was incredibly severe. And there were lots of factors in place. So that caused housing prices to drop, including so many people who, well, that's a whole nother show, but.
Yeah, I was going to say.
Yeah, I'm not even going to go there.
I could go on forever on that one.
Yeah, that's a whole nother thing. But the practices, there were certain things that.
Oh, you're cutting out, Dee Dee. Or am I cutting out?
I don't think we're going to see prices drop astronomically anytime soon. So if you are a buyer and you've been waiting to get into the market because you think prices are going to drop, I just don't think that's going to happen. And you can call me about that, and I'm happy to chat with you about it. I wanted to talk a little bit about specifically what's happening in Morgan Hill. Gilroy looks similar to this. San Jose looks similar to this. The actual numbers are different, but Santa Clara County looks very similar to this. So if you look over here, it's 2011. This is really the last 10 years. 2011, our average price was $579,000 for a single family home. And you can see there's been a nice steady uptick through 2021. Now in 2020, that's when the recession hit, or when the pandemic hit. Our average price in 2020 was $1,145,000, which is a 98% increase from 2011. So good for you. If you bought, I know it's insane. If you bought right around 2009, 2010, 2011, you hung on to that house, you're doing really, really well. You've done a phenomenal job. But even if you bought last year, which a lot of my clients got in right around when the pandemic was just hitting and we were going into lockdown and everyone freaked out. We were so nervous and, oh my gosh, what's going to happen? And they stayed the course. Thank goodness for them. They're sitting on a nice pile of cash, because from 2020 to today, actually it would have been yesterday when I put this together, it went from $1,145,000 to $1,415,000, which is a 23% increase in just 1 year. So if we're going to duke it out, Dan, I think the mortgage housing market is pretty darn good.
That's what I was gonna ask. If we see what the stock market did over that time, it won't be as much. But if we look back, just in and bring up an evil term, whatever, what people want to. How much the stock market went up, even during COVID, how much it went. It's all about the performance, correct? That's what we're talking about. But the main thing that we want to back up here is this is great, and this is all on paper, right? Same with me with the stock market. I think that there's a balance between stock market, fixed income, real estate, commodities, and so on that you have to look at. We can have a competition. I could bring back slides and say, you know what? Performance-wise, straight performance with real estate, depending on where you are. But if we look at the U.S. national average, since 1972, the stock market has performed better by about 2% per year.
Right.
But that is straight performance. I hope everybody hears me. That's from $1 to, if it's 10% return, $1.10. That's just point to point. You have to ask yourself, what are you using your money for? In the real estate, is it an income producing property? Are you using it for vacation? Do you rent it to friends and just do that? Or is it a second home? Is it straight investment property that you want to sell, flip, or whatever? So those are the questions you have to ask about real estate. Same thing with stock market. The biggest difference between both of these is the liquidity. Okay. And you understand this. Real estate, it's a long-term, a long-term investment. Stocks can be short-term or long-term, preferably long-term, so you can get the dividends and everything. But that's the key. I could get to the stocks, or I could get to my cash quickly with the stock market. The real estate, it's hung up there for somebody to buy it and get the money. Usually at least 30 days for escrow. So that's the key in each situation, is looking at the balance.
Right.
I mean, do you agree with that or what, Deneen? I love real estate, love the stocks, everything. It's all about the diversification and your own situation.
Yeah, you're absolutely right about liquidity. And the amount that you have to invest as well. When it costs you $100,000 to get into the housing market, it's very different than saying, okay, I'm going to put $100 a month into the stock market over the next 20 years and grow it, right? It's a completely different investment. If we're talking about just strict performance and percentage growth, they're probably pretty darn similar, except for the last year. The last year has been insane.
And that's what I like about having a relationship with yourself as a realtor, myself as a financial advisor. I don't want to know about real estate. I want you to know about it. And I want to ask questions and do sort of things like this so I can learn things and teach other people other things that both of our experiences and everything that our knowledge for the past however many years, a few decades. And that's what's key, is passing this on to people to realize what the difference is. The competition is always there. We can fight about performance, whatever, but there's always a play. We could take data, whatever you want to say, and do whatever you want with. So yeah, it's key to have that relationship. Yeah. Yep. Having you in my corner is always the best.
Aw, having you in my corner is the best, Dan. Little love fest here on Tuesday morning. We're old friends, so we can do that. So a little more about why we're like family, why I love real estate. And this is something I think a lot of people don't think about. You use someone else's money to get into it. You do have a large initial output for your down payment, anywhere, $20,000 on a little, condo, maybe, to hundreds of thousands of dollars if you're buying, $1.5 million home. but you also get great tax deductions out of that. And you make good money gain over the long run, and you can take a good portion of that gain tax-free. I don't know another investment where you can do that. And that goes back.
That's on your primary. That's on your primary residence.
On your primary.
Right?
I do have it in
primary
residence.
The other ones you still have to pay capital gains on.
What's that?
On any other investment properties or second home or anything, that the gain is you don't get that tax free.
Unless you exchange it. There's tricks.
Yeah,
unless you exchange it, move back into it. There are ways to make it happen, but
1031s.
If I made $500,000 in the stock market and I decided to cash out, I'd have to pay tax on that. If you sell, you have to sell your house.
There are tricks on that too.
Okay, baby. Yeah. I don't know them. You've been holding out on me, so I don't know them. So
we'll get there. We'll get there.
We should have another seminar about that, because that is some hot information.
Yeah.
Is this where the battle is? I feel like the battle is starting.
Yeah, I know. Exactly. We had to get all the information out. Yeah, there's different ways of doing things. 1031 exchanges on property, and then there's also, charitable donations, and that you can still take income from that account until you die. But there's different ways of doing everything. That's the best part about having a realtor, tax person, and estate attorney in my corner.
That sounds great. And I'm going to have Lisa Silva, who is my CPA. Yep. She's amazing. She's here in town. She's going to talk about, because you talked about taxes going up, Danny. She's going to talk about, she's going to come in like November and talk about year-end tax planning, which is super important. You don't want to plan for your year-end taxes after the year ends. You actually want to do it before the year ends so you can make adjustments and hopefully reduce your taxable income before the end of the year. So we'll have her on in November to talk about that. But then maybe we should come back in November and talk about how you save money on your investments and not pay
on your gains.
Yeah. No, well,
that's a huge thing.
So what's next in real estate, real quick? Prices will continue to go up, but at a slower pace than what we've seen in the last year, which has been, as you saw, insane. Inventory is going to remain low. I don't think there's especially in our area, there's so many people that want to live here. It's great to live in a place where so few people want to move and they aren't selling their homes. So the demand will stay very high until there is some kind of an event like higher interest rates that will cause buyers to pull back. We saw that in 2019. Where 2018 was a bananas market, kind of like this last year. 2019, buyers pulled back, and we saw inventory increase and prices moderate because interest rates went up. And then I really do believe, especially in our area, real estate is going to remain a great investment.
Yeah, that's the key point. Like what you say is real estate is location. This area, we're in a bubble, with real estate. It's just crazy, That's but I mean, like we're like the Silicon Valley is a different animal than the rest of maybe except for New York, but it's like the coasts are bad. It's just crazy.
It's so unique here.
It's so unique.
It's amazing. The diversity of people,
it's awesome.
The diversity of everything here is amazing. The culture, the proximity to things. I went for my birthday, went to Pebble Beach for the day, and I mean, you've got that an hour away, one of the most beautiful coastlines in the entire world. You've got Yosemite. You're a couple of hours, 3 hours away from the mountains and skiing. I mean, it's just one of the best places to live ever, anywhere. And that's why everybody wants to come here. So any questions? Do we have any questions, Lori?
I don't see a single question. I just asked.
We just did great.
Brian, you just covered everything.
Love it.
What a great team. All of us.
If there are any questions, certainly you can reach out to me at lori@morganhillchamber.org, and I can get in touch with either Dee Dee or Dan and get your questions answered and get that back to you. But no, I think we have to proclaim you both winners. I don't think there was a clear one either way. I think it was a tie, depending on your circumstances, right?
Exactly, and I agree with that wholeheartedly. I even tell Dee Dee, we went through a different situation. Just going through and talking about things, and talking about real estate compared to what she wants to do with her money, compared to what an individual over here wants to do. It all depends on the situation.
Yeah. What your goals are. Your individual goals are really what decides what you need to do with your money and what you have available to you.
Excellent.
So is it ever too late to get started in investing either way?
No, it is not. Dee Dee brought up $100 a month or a paycheck or whatever, even if it's $25. Start putting something away. I don't care how old you are. If you can manage $50 a month, put it in a Vanguard S&P real estate fund that has the S&P and the real estate in there. You got both of them going for you.
Yeah.
But that's, just start doing it. Period.
You've just got to, you've got to start somewhere.
Just do it. Okay.
And thank you again for letting me do this in my car, because I did have to I did get my client to the oncologist. Everything's good. We're doing well. But now I'm going to get his mail and get him into bed.
You're the best, Annie.
Thank you, everybody, for joining us.
Thank you, everybody.
All right.
Take care.